Hello, welcome back. I'm with Ronald-Peter Stöferle, the fund manager over at Incrementum and the author of the In Gold We Trust report. Ronnie, good to see you to start with.
Hi, Peter. Thanks for having me.
Obviously, we're both at the Precious Metal Summit in November, and this is another warm-up video to that before your presentation with Grant Williams. And I guess the purpose of this call is really to get a pulse on the gold market at the moment and really get a bit of insight into some of the things that you're going to be talking about at the conference. I guess to kick things off, I wouldn't mind sort of touching on something that you mentioned in the report, and that's actually around the relationship of gold in regards to other currencies. We've seen all-time highs in virtually most currencies other than the US dollar, and I wouldn't really mind wondering or picking your brain on why that is and what needs to happen. I guess what's the trigger for the US dollar to really reach them all-time highs?
Well, I think the US dollar is still kind of the least dirty shirt and still some sort of a safe haven. And I mean, in summer, the dollar index was trading at around 100, and now we're trading at 107. So we've seen a pretty significant move of strength in the US dollar. But still, the gold price held up very, very well. And now we are really very close to new all-time highs, also in US dollar terms. And I think the fact that gold is holding up so well against this enormous move in rates, and especially in real rates, because it's not only interest rates going up, it's also inflation numbers coming down. This is an enormous sign of strength. My friend Shane McGuire said it when we were talking about, gold in different currencies. He said, I don't think the question really is what gold is worth, but what currencies are not worth. And I think that's a great quote that basically sums up my value proposition for gold.
There's been a prolonged period of low to negative interest rates in real terms. And you mentioned something along the lines of this period of negative interest rates has to come to light eventually. What do you mean by that?
Well, we've seen that this long period of low and negative rates obviously fueled bubbles, and that we saw this everything bubble being blown up over many years. And now it seems that we're seeing the bursting of that bubble, particularly in the bond market, where the last 3 years have been really rough. And I think we haven't seen 3 negative years in bond markets since the year 1700 something. Yeah, so it's really historic what happened in bond markets. And usually the next market or the next shoe to drop would be equities. And we're already seeing in the more illiquid pockets of the market that there is huge turmoil. So I think, Peter, central banks completely underestimated inflation risks. We put out a special report in 2020 where we said, okay, now would be the time to slowly and cautiously start hiking interest rates again, to slowly and cautiously reduce the liquidity in the system, not only from central bankers, but also from fiscal policy. Of course, nothing happened. And up until basically spring 2022, everybody said inflation is only transitory. And then they had to hit on the brakes very, very hard. So they have been, it's the same old game, yeah. Over easen and then over tighten. And I think now it is pretty obvious that this enormous move on the rate side is causing an enormous amount of trouble. So our base case actually is a hard landing and not a soft landing that is being priced in by markets. And I think the bond market now has already, it's starting to discover that this higher for longer narrative is complete BS.
So we're just going to take a quick pause there, and I wouldn't mind tagging in Grant Williams, the author and publisher of Things That Make You Go, Grant, good to have you on. Obviously at the conference, you're going to be doing a Q&A with Ronnie. You've got a bit of insight as to what the presentation might be on already, but what are the key things that you want answers to around the gold market at the moment?
Well, look, I think there's so much uncertainty around right now, and gold is supposed to provide certainty in times of uncertainty. So it should be a perfect time for gold. And I think the thing that's kind of got a lot of people questioning things is a weird one for gold. Normally we wonder why it's doing so badly, but the question for me right now is why is it doing so well considering what's happening with rates? So that's the question that I'm pretty sure Ronnie will have an answer to, and I can't wait to hear it.
Ronnie, perhaps you could touch on that maybe it's just slightly at the moment, just where your head's at on that particular point.
Those developments that totally come out of the blue, that makes it interesting for me as an analyst and a fund manager, because if you would have told me that real rates would rise basically by 315 basis points in just 18 months, I would have told you that probably the price of gold would be trading at like 1,500, 1,600, something like that, because there's a very, very tight positive correlation between real interest rates and the price of gold, and between 10-year tips, for example, and the price of gold, the correlation is 91%. So they are very, very closely tied. Now, we have seen a big divergence between real rates and the price of gold. And from my point of view, it is primarily central bank buying that does explain that development. So last year we saw more than 1,100 tons of gold being bought by central banks. For the first 3 months this year, actually, we're seeing I think more than 800 tons, which is also an all-time high in that period. And obviously, the major buyers are central banks in emerging markets, particularly obviously China, but also Turkey. But we've also seen Poland buying very, very aggressively. And I think, the question is, why are they buying gold? I think it's mainly because, some sort of loss of trust in the rule of law, loss of trust in, international relationships. And it all started basically with the sanctions by the US and the EU against Russian reserves. So I think this has been the starting point. And many countries that are somewhat critical of US policies, they just started piling up gold reserves and started diversifying out of their dollar-denominated reserves. So I would say this is the main reason. And to make a positive case, we've got a couple of charts that actually show, once we see, the pause in this rate hike cycle, and then actually usually the Federal Reserve would start lowering rates again. This will really be the point in time when gold picks up momentum. This will be the point when also Western financial investors start buying gold again, because they have been completely on the sidelines. So I think, that the starting position for this bull market couldn't be any better.
Well, we did just see a rate pause. Obviously, the Fed and the Bank of England have both decided not to increase rates. Are you seeing this as the start of that scenario where we are now? Hopefully, economies are strengthening and we are going to be seeing rates decrease and a scenario where gold will rally?
It's interesting that we kind of tend, through habit, to talk about cutting rates as a positive. Generally speaking, that's not a good thing. It means the economy's struggling. It means, stimulus is needed to either avert recession or help clear a recession. And markets have become completely conditioned to think that cutting rates is a good thing. And it's completely understandable given how much reinforcement they've had over, 40 odd years. But it's problematic. And I think, Ronnie's hit the nail on the head with the sanctions and the central banks. And I think, Ronnie, if we look back through history in the other direction, once central banks start trending in a given direction, they're not swing traders, right? We had the Washington Gold Agreement that put a ceiling on gold for many, many years as they just relentlessly sold. That turned around. We saw that, and you put some fantastic charts in the In Gold We Trust report showing how that turned around aggressively. But what we haven't seen really is aggressive buying from central banks, and to see that in the last kind of 9 months, for me, is an incredibly positive sign, because I don't think it's going to be 9 months and done. There's an awful lot of diversification that needs to happen, simply because there are so many countries wedded to the dollar. Basically any country that trades in energy, either imports or exports,
Yes.
is holding a significant amount of dollar reserves through necessity. And gold is the obvious alternative to treasuries. It's liquid. It's a decent market. It's not as liquid as treasuries, obviously, but it's a decent market, and it's certainly better than any other kind of sovereign bonds at the moment in terms of credit risk. So for me, I think, as Ronnie said, there are plenty of signs that the forces aligning behind higher gold prices are here to stay for a while. And if we do get a rate cut, it may initially, as we saw in 2008, if that rate cut is associated with some kind of market event, we may see a rush for liquidity. We may see gold get liquidated. But ultimately, I think if we see rate cuts again and we see money printing and a return to QE, which sadly I fully expect to happen, I think this will be the time when we really see gold react to that, because you have that price insensitive buyer and central banks sitting underneath it on the bid.
Grant, I couldn't agree more, and I think that initially the equity markets will celebrate the rate cuts, but then at some point they will realize, well, actually it's not a good thing, because they do it for a reason, and we have seen this everything bubble being blown up, and now the first really big casualty was obviously in the bond market, where treasuries with maturities of 10 years or more have plunged almost 50% in value. And usually I would say that equity would be next. And somebody tweeted that out, and I thought it's an interesting thought, that he said that paper losses in bonds feel like an opportunity cost, because you just wait it out and you will make it all back. And paper losses in stocks feel like a real cost, because the money is probably gone forever. I think this explains quite a lot of, this sense that we're seeing from bond investors saying, well, actually it's not that bad. We're down, but we're holding to maturity. But then on the other hand, you'll only get back the nominal value. So let's put it that way. One of my main calls is basically that the great moderation is over. And during the great moderation, we saw, very low inflation volatility. Actually, inflation was the least concern for the construction of your portfolio. And my take is that over the next couple of years, we will see much, much more inflation volatility. So I would say that at the moment, although inflation remains quite sticky, but the developments that we're seeing in markets are actually quite deflationary. When it comes to gold, I think that gold is already kind of sniffing out this inflation volatility, and it's kind of realizing that inflation will remain a concern. And I think that the bond market hasn't really realized that this great moderation is over, because most of the participants are still kind of playing with the same rules like in the previous regime. And this great moderation was around for basically 40 years. So that's a generation of asset managers that have got no clue how to structure their portfolio when you see higher inflation volatility. And I think this is like my longer term call. I just cannot see that gold in such a long term environment where inflation really becomes one of the most important factors for portfolio construction, that gold doesn't play a major role.
I wouldn't mind one last question just on the actual equity market, especially within mining of gold. This is a precursor to a conference really dedicated to the junior mining market. And I really wouldn't mind getting your thoughts on where that market goes from here, because it seems like we're at rock bottom as we stand.
Well, it's tough out there. I mean, I was at the Precious Metal Summit in Beaver Creek in September, and it was saddening to see so many good people in the industry really suffering, and doing financings to just keep the lights on, and I think it hasn't got any better since then. And we're seeing this divergence in the market where the producers are still doing fairly well. Of course, inflation on the cost side is a concern, but the margins are healthy, and we're seeing decent free cash flows being produced. But then when it comes to the developers and when it comes to the juniors, they've been killed over the last couple of months, and I think that, as always, quality will stick around. But I think there's many companies that will go bust, and perhaps that's even a good thing. I just remember there was a big wine scandal in Austria in the 1980s, and everybody said that's the end of the Austrian wine industry. But actually, it was the best thing that could happen for Austrian wine, because the quality got better and better, and the companies started working much more professional. So therefore, I would say if you've got rubbish junior mining companies, well, it's gonna be tough. Probably you can write them off. But if you stick to the quality names, I think it's even a good time to start averaging in. I think you're getting really decent valuations, and I think at some point, when risk appetite really comes back into markets, I think investors would start considering mining stocks again. But I still think we're still a bit away from that moment. So I wouldn't get overboard with buying into the junior mining space. But I think now is really the time to do your homework, to start increasing positions at very, very low valuations.
I'll just add a couple of things to that. First of all, good assets and good management. That's the things to focus on. You need good deposits in good jurisdictions with proven management teams. If you're gonna look at these companies, for sure, that's absolutely a starting point. And for me, it's a non-negotiable starting point. You don't fuzz around that. It's an absolute black and white line. The second thing I'd say is that gold, because it doesn't, it's not a company, you can't analyze it. It's always been a story asset. There has to be a story around it. And, for good or bad, there's always a story that drives the narrative around gold. And if you look at the landscape now, there's a very positive story that can be told by people about where we are in the cycle, about how it's performed, about the central bank buying, about, the potential weakness in the economy, weakness in the bond market, diversification. There are all these stories that can be told to try and attract capital into the gold market. And when you have a good story or several good stories, and you have beaten down valuations, and you have the kind of potential for gains that gold miners historically have demonstrably offered, you'd be amazed how quickly capital can be persuaded to come into this sector. And when they do, the sector is never big enough to accept that capital without significant moves. But really, it's going to be the good assets. The money that's going to come in is smart money. There's an awful lot of kind of dumb money. I don't mean that in a pejorative sense. I just mean that in the way that it's described in markets. There's a lot of dumb money that's kind of, lost, abandoned capital in miners that people have gone all in too early, and they've just watched the prices dwindle, and they don't have the capacity to average down in many cases. The money that will come in next is going to be really smart money, and they're going to go for the companies I just described. They're going to go for good deposits in good jurisdictions with good managements. And, I suspect at some point we will see, as we start to see in the energy space, a decent amount of M&A activity in the mining sector as well, which again is just another positive story. So I'm always an advocate of owning gold. I wouldn't say I'm always bullish, but I always think you need to have an allocation to it. But every now and again, there's a good setup where I think it's much more prudent to say, look, I'm bullish for the gold price in the medium and long term. The short term, everything's choppy at the moment. Everything's volatile. There's volatility everywhere you look, and you have to expect that. But I think going forward, as I said, there's a really good story to be told here that will attract capital into a beaten down space.
Brilliant. Ronnie, Grant, thank you for your time. And for those interested in coming along to the conference and watching the presentations, I'll be putting a link in the description below. But Ronnie, Grant, very pleasure to have you here.
Peter, thank you, Ronnie. I'll see you soon, my friend.